Wow, tonight the headlines are pretty, urgent. China has just hit back, with the 34% tariff on all U.S. imports, a tit-for-tat response to what President Trump just did.
Yeah.
And the markets, well, they're not happy. The Nasdaq has plunged over 20% from its highs.
Oh, wow.
Oil prices have slid to, like, 2-decade lows, and, people are starting to talk seriously about a global recession. So where do we even begin with all of this?
It's a lot to take in, right?
Yeah, it is.
It feels like every time you refresh the news feed, there's another, twist or turn. But I think to really grasp what's going on, we got to zoom out a bit.
Right.
Get past the day-to-day drama and look at the bigger picture of global trade.
Exactly. Because, as dramatic as these headlines feel, trade conflicts, well, they're not exactly a new thing.
No, not at all.
I mean, they've been brewing for centuries.
They have this long, complex history, and, there are deeper reasons behind them, reasons that go way beyond just, the latest tariff announcement.
And that's where our deep dive comes in tonight. We're going to be drawing on Matthew C. Klein's book, Trade Wars Are Class Wars.
Oh, great book.
Yeah. Even the title gives you a hint that this isn't your run-of-the-mill trade analysis.
No.
Klein's argument is that rising inequality within countries, it's actually a huge factor driving trade conflicts between them. So it's not just about, national rivalries or trade deals gone wrong.
A whole new perspective.
Yeah, it puts the spotlight on what's happening inside each country's economy.
It suggests that these tensions we're seeing, they might not be about, one country trying to get a leg up on another, but rather they're like these outward signs of deeper economic shifts and imbalances.
So tonight, we're going to go deep into those complexities, move beyond the headlines about trade deficits and surpluses. And by the end, hopefully, we'll all have a better understanding of, first, how we got here.
Right.
And second, all these economic anxieties that are like bubbling beneath the surface.
I mean, just think about it. How did international trade even become such a, global flashpoint?
Yeah, great question. I mean, to answer that, we need to go back and see how trade has evolved.
Exactly. I mean, it definitely hasn't always been this intricate web of global supply chains that we have today.
No, not at all. Early trade was actually really limited. Trying to move goods across continents, especially centuries ago, it was a massive undertaking.
It was.
The costs were huge, and there were all sorts of political roadblocks, so trade was much more localized.
Right.
But even then, you had these fierce debates about the right approach. I mean, you had British thinkers, Adam Smith, David Ricardo.
The classics.
They were really pushing for free trade, emphasizing, specialization and efficiency, like let each country do what it does best and everyone benefits.
And yet their ideas weren't universally embraced, were they?
No. You had figures like Alexander Hamilton in America.
Of course.
And Friedrich List, who was German. They were promoting a different strategy using protectionist measures, like tariffs, to support new industries at home, help them grow and diversify.
So like shielding them from foreign competition until they could stand on their own 2 feet, basically.
Yeah, basically. And then things shifted after the Napoleonic Wars. The invention of steam power, the telegraph, it really lowered those barriers of transport and communication.
Massively.
It triggered this surge in international trade, which we now call the first globalization.
Right. It was the first time we saw trade on a truly global scale.
Yeah. But like a lot of booms, it didn't last forever. The party ended pretty abruptly with the Panic of 1873, which some historians actually see as the world's first synchronized global financial crisis.
Wow, interesting.
I know, right? I mean, it's like history rhyming. And then, on top of that, you had the rise of high imperialism in the late 19th, early 20th centuries. And while that boosted trade within empires, it created these new barriers between them.
Yeah, it really reshaped global trade patterns.
Totally. And then, the first half of the 20th century was just, it was chaotic. World wars, the Great Depression, revolutions, all these events devastated international trade. It was worse than it had been since the late 1700s. But here's the ironic twist. Within a lot of wealthier nations, this period saw a pretty significant redistribution of wealth.
So things actually became more equal.
Yeah, at least for a while, income distribution was more even than it had been before.
And then came a real game changer, the container revolution.
Yes.
So by the late 1990s, we had these standardized shipping containers.
Right.
And these, incredible advancements in communication technology.
Yeah.
And together, they basically slashed transportation costs.
Yeah.
and they made it possible to manage these super complex global supply chains.
Yeah.
To give you an idea, back in the 1950s, just shipping something from the US to Europe, it could take months. It was crazy inefficient.
Yeah, months. It's hard to imagine that now, right?
It is. It's like trying to picture life before the internet.
Totally. But this whole shift, it really challenged some of those long-held beliefs about trade. Like, take Ricardo's theory of comparative advantage. It's a cornerstone of free trade, but it was based on this idea that moving capital and labor across borders was really hard. And, well, technology has basically made that not so true anymore.
Right. The world has become a much smaller place.
Exactly. And Ricardo even thought that property owners would rather accept lower returns at home than deal with the hassle of investing abroad.
Which is just fascinating when you think about how globally interconnected investment has become.
Yeah. And that brings us back to the American system that Hamilton was so keen on. His big idea was to use government support, like tariffs and subsidies, to build up American industries. And it wasn't just about making money.
No.
It was also about fostering innovation at home and creating a strong domestic market until those infant industries, as he called them, could compete on the world stage.
And Klein really emphasizes how Friedrich List, the German thinker, admired this American system.
He did. He saw it as a potential model for German unification. For List, it was as much about national power and independence as it was about economic success. So you can see how these different ideas about trade were taking shape and evolving over time.
Yeah, they laid the groundwork for the kind of debates and conflicts we're dealing with now.
Absolutely. And it's a good segue into talking about these trade imbalances that we're seeing today. Klein argues that they often happen because some countries just aren't spending enough and are saving too much. But he's quick to point out it's not about being like culturally thrifty.
Right. It's not like these countries are full of, Scrooge McDucks hoarding their wealth in giant money bins.
No, not at all. His argument is that this oversaving tendency can be tied directly to income concentration, where the wealthiest people are getting a bigger and bigger share of the economic pie. And they, by their nature, save more of their income.
While people with lower incomes need to spend more just to cover their basic needs.
Yeah, exactly. And this creates a situation where some countries are producing more than their own people can consume.
So this surplus production, this glut, has to go somewhere.
It does, and it ends up being absorbed by other countries that are spending more, often running trade deficits.
Yeah.
If that doesn't happen, well, the global economy could slow down because there's just not enough demand.
I see. It's all about finding that balance.
It is, and this idea of a glut isn't new, Klein brings up John A. Hobson, who, back in 1902, argued that imperialism itself was fueled by surplus capital in the hands of a wealthy elite. He called them a plutocracy with excess consuming power they cannot use.
So they needed to find outlets for their surplus capital abroad.
Yeah. Hobson's point was that if income was more evenly distributed in wealthy countries, it would create larger domestic markets with enough buying power to, absorb that extra production. And guess what? He said there wouldn't be any need to open up new foreign markets if income was properly distributed at home.
That's incredible. So over a century ago, he was basically describing the dynamics we see today with trade imbalances between countries like China, Japan, and Germany.
It's amazing, right? Like history repeating itself. And this brings us to the high savings model of development. It's this strategy where a country intentionally suppresses domestic consumption to free up resources for investing in things like infrastructure and capital goods.
Right, so it's like putting off immediate gratification to build for the future.
Exactly. And we've seen this play out in history. The most extreme example is probably the Soviet Union under Stalin, where forced collectivization and industrialization came at a horrific human cost.
Yeah, it's a dark chapter in history.
It is. But Japan also adopted a version of this after World War II, although their approach was much more humane, based on a social contract between workers, businesses, and the government. They all agreed to prioritize long-term growth over immediate consumption. And while it can lead to rapid development, as Klein points out, it's ultimately a trickle-down approach.
Which means there are winners and losers.
Definitely. And it creates these inherent tensions. I mean, you're essentially saying, okay, we're going to accept lower living standards now so that maybe someday everyone will benefit. But there's no guarantee of that, right?
And it can exacerbate inequality.
For sure. And then, fast forward to today, Klein talks about this great glut in recent times. He points out that the cost of manufactured goods has gone down dramatically, while asset prices are high and investment yields are low.
So what did that tell us?
Well, it suggests that globally we have tons of productive capacity. We can make lots of stuff cheaply. But at the same time, those high asset prices and low yields show that there's a huge desire for future consumption.
Like people are saving a lot, but don't have many good places to invest it for a decent return.
Yeah, exactly. And that brings up another misconception. People often think more saving automatically equals more investment. But Klein pushes back on that.
He does. And it's an important point. He says whether higher saving actually turns into more investment depends on the overall economic environment and whether businesses see good opportunities. Sometimes it works the other way around.
How so?
Well, if you have more investment leading to more output and efficiency, that can actually create more saving within an economy. It's not always a one-way street.
Got it. And Klein even brings in Mariner Eccles, who was the Fed chairman during the Great Depression.
Right. What does he have to say?
Eccles believed that the huge income inequality of the 1920s was a major factor in causing the Depression. With so much income concentrated at the top, there wasn't enough spending by ordinary people to absorb all the increased production. And that, in turn, discouraged businesses from investing more.
That makes sense. So it created a vicious cycle.
Yeah, pretty much. And all these trade imbalances we've been talking about, they're not just abstract concepts. They show up in a country's national accounts.
All right, they have to.
The basic equation is a country's exports minus its imports will always equal its domestic saving minus its domestic investment.
So even though we often talk about trade in terms of, goods flowing across borders, it's really a reflection of a country's internal dynamics.
Exactly. And to see how all this plays out in the real world, let's look at some examples. Let's start with Germany.
Okay, sure.
Now, Germany is a really interesting case study, especially after reunification. The eastern part of the country was struggling economically, and Klein points out that this had some unintended consequences for the West.
Oh, how so?
Well, West German industries basically used the threat of moving production to Eastern Europe, where wages were lower, to keep wage growth in the West suppressed during the 1990s.
Wow, I didn't realize that.
It's pretty striking. Real wages for West German manufacturing workers barely budged during that whole decade.
And this prolonged period of weak domestic demand in Germany, particularly after reunification, is a big part of the reason they ended up with these huge trade and current account surpluses.
Yeah, and the fiscal rules of the Maastricht Treaty and the Stability and Growth Pact also limited the government's ability to boost spending.
So they had these external constraints on their fiscal policy.
Right. And on top of that, Klein highlights rising income inequality in Germany and the fact that they got rid of their wealth tax in the 1990s.
How did those factors play into their trade surplus?
Well, they likely contributed to a higher household saving rate. So you had German consumers and the government underspending compared to what the country could produce, which effectively transferred purchasing power to consumers in other countries.
I see. And they used that purchasing power to buy German-made goods.
Exactly. And we should also mention the Schuldenbremse, which is like a debt brake written into Germany's constitution.
Oh, yes.
It's further limited the government's ability to invest in things like infrastructure, which could have stimulated domestic demand and maybe reduced their reliance on exports.
So their own policies sort of locked them into this export-driven model.
Yeah, in a way. Now let's shift gears and talk about China. Klein's argument is that there's been a systematic transfer of wealth from Chinese workers to the elites, which has distorted their economy.
So, in effect, they're suppressing consumption to subsidize production for export.
That's the gist of it. And the labor share of corporate value added in China is noticeably lower than in a lot of other countries.
And what about the hukou system? I know that plays a role here too, right?
Oh, definitely. It creates this huge divide between urban and rural populations, and it limits the social mobility and spending power of a lot of migrant workers who move to the cities for work.
So it's got a really regressive impact on overall consumption.
Yeah, big time. And all that suppressed consumption has fueled their incredibly high saving rate, which has then funded massive investments in infrastructure and manufacturing. Klein points out that local governments in China, which are often driven by, ambitious growth targets and not always subject to strict budget constraints, they're a major force behind this investment.
So it's like this top-down push for growth fueled by low wages and high saving.
Pretty much. And China's also been focusing more and more on import substitution, trying to become less reliant on manufactured goods from other countries. But Klein points out some discrepancies in their trade data, especially when it comes to travel service imports. So the real picture might be more complicated than what the official numbers show.
Interesting. And while China's GDP growth might not be derailed by trade wars in the short term, Klein does raise some concerns about the long-term sustainability of this model.
Yeah, for sure. Okay, so now let's talk about the United States, the land of the persistent trade deficit. Klein explains that foreign saving flowing into the U.S. can, in certain circumstances, lead to a crowding out of domestic production. So basically, it can make it harder for U.S. businesses to compete.
Right. It's like foreign capital is coming in and, in a way, taking the place of domestic investment that would otherwise be happening.
Yeah, that's a good way to put it. And he contrasts this with what happened in Spain, where their trade deficits were driven by a huge investment boom.
So it's all about the underlying reasons for the deficit.
Exactly. Now, there's been a lot of debate about whether the U.S. government's fiscal policy, its spending and taxes, is the main culprit behind the U.S. current account deficit. Klein goes through the arguments from different economists on both sides.
And what's his take on it all?
Well, he points to data suggesting that changes in the private sector, like how much households and businesses are saving and investing, often offset changes in fiscal policy.
So it's not as simple as saying, oh, the government is spending too much, therefore we have a trade deficit.
Right. It's more nuanced than that. And Klein also talks about these indiscriminate inflows of foreign capital into the U.S.
What does that mean exactly?
Basically, it's when a lot of foreign money flows into the U.S., not necessarily because there are amazing investment opportunities here, but more because they're looking for a safe haven or a decent return. And this influx of capital can inflate American purchasing power, making imports cheaper and more attractive, which widens the trade deficit even if U.S. industries aren't becoming less competitive.
So it's not just about, American products being too expensive or U.S. companies not being productive enough.
Right. There are these larger global forces at play. And he also goes into detail about the boom and bust of U.S. business investment in the late 1990s and how investment levels have been much lower since the 2008 financial crisis. And he ties this to the safe asset shortage and the demand from foreign central banks.
Right. So how did that contribute to the 2008 crisis?
Well, this global demand for low-risk, safe assets, like U.S. Treasury bonds, along with foreign central banks wanting to hold dollar reserves, it kept interest rates in the U.S. really low. And that fueled the expansion of mortgage credit and led to, looser lending standards, which ultimately contributed to the housing bubble and the whole financial mess.
Like a domino effect.
Yeah, totally. And Klein also points out that during the 2000s, even though the U.S. economy was growing, a lot of the increased demand for manufactured goods was being met by production overseas. So even though things seemed good on the surface, it was leading to job losses in the U.S. manufacturing sector, despite some earlier successes in the 1990s when global demand was stronger. And that manufacturing trade deficit has been really stubborn, even after the 2008 crisis.
It's a complex picture.
It really is. And then there's this shift after 2014 where non-reserve managers became the main funders of the U.S. deficit instead of foreign central banks. So that suggests something's changing in the nature of these capital inflows.
Right. It's not just governments anymore. It's private investors, too.
Yeah, exactly. Okay, so now let's talk about the global monetary system itself and how it all ties into trade. It's come a long way from the gold standard to the dollar-based system we have now.
It has. And the gold standard, while it provided some stability, it had its limitations. It wasn't very flexible in responding to changing economic conditions. And the rise of central banknotes laid the foundation for a more adaptable system. And then came Bretton Woods, which established the dollar as the linchpin of the international monetary system.
Right, the dollar became the world's reserve currency. But as we know, Bretton Woods eventually collapsed in 1971. Inflation was rising, and U.S. gold reserves were under pressure. What happened after that?
Well, after Bretton Woods fell apart, a lot of countries, especially in East Asia, decided to actively manage their exchange rates and build up big foreign exchange reserves. This was particularly true after the 1997 Asian financial crisis.
And Klein argues that while this is often seen as a way for countries to protect themselves, it has an economic impact that's a lot like mercantilism.
Which basically means trying to maximize exports and minimize imports.
Yeah. So how does managing exchange rates and hoarding reserves fit into that?
Well, by keeping their currencies artificially weak and accumulating reserves, These countries are essentially suppressing domestic spending and making their exports more competitive on the global market.
So it's like a hidden form of protectionism.
In a way, yes. And China has been the biggest player in this game.
And this brings us to a really interesting concept, this idea of the exorbitant burden rather than the exorbitant privilege of the dollar being the world's reserve currency.
Yeah, that's a provocative way to put it. So what's the argument there?
The argument is that having the dollar as the dominant global currency forces the U.S. to absorb the world's excess savings and production. And this can lead to deindustrialization and more financial instability in the U.S. Klein even brings up John Maynard Keynes' proposal for a global currency called Bancor, which was designed to address these imbalances in a more symmetrical way. But it never got off the ground.
It's fascinating to think about how different the world might be if that had happened.
Yeah, it makes you wonder. Okay, so let's bring it all home. What's the key message of Klein's book?
His central argument is that these trade wars we're seeing are really about class conflict. The rising inequality within countries is a major driver of the global imbalances that then erupt as trade tensions.
So it's not just about, which country has the lowest wages or the most favorable trade deals.
Right. It's about the distribution of wealth and income within those countries.
Exactly. And if that's the case, then slapping tariffs on imported goods is probably not the answer. In fact, it could make things worse.
Yeah, Klein points out that other countries are starting to look at capital controls as a way to manage these pressures.
And he emphasizes that the real problem, the lack of enough global spending, it originates in those surplus countries with highly unequal income distributions.
So the solution lies in addressing those internal imbalances rather than just focusing on trade barriers.
Right. And he offers some ideas for what those surplus countries like China could do. Things like reforming the hukou system, expanding social safety nets, giving workers more power, making sure state-owned enterprises face fair competition, and taxing wealth more effectively.
So it's about rebalancing their economies from within.
Yeah, exactly. And ultimately, Klein argues that those dramatic headlines about trade wars, they're really just symptoms of a much deeper problem, the way wealth and income are distributed around the world. And to find real, lasting solutions, we need to address these internal class dynamics rather than just obsessing over trade barriers.
It's a powerful message.
It is. So to wrap up our deep dive into trade wars are class wars, we've learned that the trade tensions we see in the news, they're not the whole story. They're actually symptoms of a much bigger issue, growing inequality within countries, which spills over into international economic conflict.
And as Klein argues, understanding these deeper forces gives us a much richer and more valuable perspective than just reacting to every tariff announcement or market swing.
And that leads us to a final thought for you to ponder. If Klein is right, and these trade wars are really class wars in disguise, what fundamental changes in economic policy and social structures might we need to create a global economy that's more balanced, more stable, and benefits everyone, not just a select few? It's a question worth exploring further, and we encourage you to check out Matthew Klein's book and do your own research on this critical topic.
I agree, it's definitely food for thought.